Good evening. It's my privilege to be back again to talk about the quarterly results of Reliance. In many ways, this has been another great quarter with several milestones. To begin with, let me share with you the biggest news of this quarter. The subscriber base in our mobile data network of Jio crossed 25 crores. That is more than 250 million individual subscribers are now on the network. Another important milestone is that the revenue from Jio's connectivity business crossed another milestone of 10,000 crores in this quarter. Our retail business also set records with revenue in excess of 32,400 crores, more than twice in the same time last year. And from our energy businesses, we had record production in our petrochemical segment, and we had record EBITDA also from our petrochemical segment, up nearly 56% year on year. All this in a macro background which was marked by, firstly, continuing tailwinds to consumption expenditure, which saw and underlined the good results in both retail and Jio. Volatility and higher oil prices, which are beginning to impact margins and energy costs. Depreciation of the rupee by 6% quarter on quarter, which leads to higher input costs, but for us in our energy businesses is fully offset by better earnings. And we also saw higher traction in domestic demand growth for petrochemicals, 7% odd in polymers, and 14% plus in polyester. As far as the quarterly financials are concerned, we had revenues in excess of, on a consolidated basis, in excess of 1,56,000 crores, up nearly 55% year on year. Quarterly segment EBITDA in excess of 21,000 crores, and therefore on an annualized basis reaching nearly 85,000 crores in this quarter. Record quarterly consolidated net profit of 9,516 crores, also up 17% year on year. We saw the highest ever contribution in EBITDA terms from our petrochemical segment, from retail and from Jio, and we saw stable numbers out of our refining business. Our consumer businesses continue to become a larger and larger part of our consolidated earnings and now account for nearly 24% of EBITDA. Quick high-level view of our businesses in petrochemicals. Not only did we have the highest ever volume, we also had the highest ever level of EBITDA, and we also saw a near 5-year high in the integrated polyester chain margins. The polymer business was slightly softer, and we will talk about that later. But we managed to get ethane cracking started at Nagothane, completing the ethane project and giving us unmatched feedstock flexibility. In refining margins came in a bit softer than the previous quarter, but still very respectable at $9.50 per barrel. This quarter, apart from being volatile in terms of oil prices, saw soft gasoline margins, a tighter crude market, but a stable market for middle distillate margins. All in all, this was a satisfactory quarter as far as refining is concerned. On the domestic front, we opened more fuel retail outlets and now have 1,343 outlets fully functioning. As far as upstream is concerned, we saw unit realization higher because of higher oil prices and marginally higher gas prices. We continue to see natural decline in both our domestic as well as US portfolios. On the new projects, we are now implementing the R cluster project and have started ordering all the long delivery items. Jio is clearly the standout performer in this quarter in terms of new milestones. It is the largest mobile data network in the world. It is the largest VoLTE network in the world. And it is also the largest wireless data network in India, with over 252 million subscribers as of September 30th. We have industry-leading ARPUs of rupees 132 per month. We have a robust EBITDA of 3,570 crores, EBITDA margin of nearly 38%, and we have 72% of the entire industry's 4G data traffic on our network. Retail, we continued our scorching pace of growth. We opened 600 plus stores during the quarter, which roughly translates to about 7 stores every day. Turnover at 32,436 crores, 121% up year on year and 25% up quarter on quarter on a sequential basis. EBITDA at 1,392 crores, over 3 times comparable time in the last year. And we have now an unmatched footprint across 5,800 towns and cities with over 9,100 stores open. Our consolidated financials, and I'm looking only at sequential quarter here, revenue up nearly 10% to 1,56,000 crores. EBITDA up 0.4% to 21,156 crores. And net profit up 0.6% to 9,516 crores. As far as revenues are concerned, the growth quarter on quarter clearly came mostly from our consumer business and to some extent from our petrochemical business coming out of higher volumes. As far as earnings are concerned, EBITDA and EBIT growth. In petrochemicals, we had higher volumes and from both paraxylene and PTA. We had 5-year high integrated polyester margin environment, and we also saw the benefit of a slightly weaker exchange rate that I talked about earlier. At the same time, for EBITDA, we saw increased contribution from both Geo as well as retail. Interest costs in this quarter were higher, as you know, the projects are getting capitalized and the higher oil prices are leading to higher working capital requirement. Consolidated return on capital employed continued to improve and on an adjusted basis moved up to 13.6% as compared to 13.3% in the previous quarter. Our EBITDA mix for this quarter, roughly 45% from petrochemicals, roughly 29% from refining, and about 24% from our consumer businesses. About our refining business in this quarter, as I said earlier, GRM at $9.50 per barrel, EBITDA at 6,094 crores, flat quarter on quarter. This quarter was marked by tighter crude markets. Not only did we see slightly higher prices for all the markers, we also saw a tightness in the markets where suppliers who are supplying on OSP basis or against markers continued to tighten the markets and take advantage of the tight demand-supply situation. We saw Arab light heavy contracting from $3.2 per barrel to $2.6 per barrel. We saw fuel oil tighter. All in all, tighter crude markets were the principal reason for seeing a contraction in refining margin relative to the previous quarter. We also saw slightly soft gasoline margins, roughly 30 to 40 cents per barrel, lower than what we were able to achieve in the previous quarter. On the other hand, middle distillates stayed very stable, in fact slightly better than the previous quarter. When we look at the benchmark of Singapore, gross refining margins complex, they were slightly higher actually in this quarter, simply because in their slate they do have fuel oil and gasoline at a lower level, and therefore Singapore margins, complex margins stayed stable at $6.1 per barrel. Our own outperformance to Singapore complex was $3.4 per barrel, And though it is lower than the 4 plus that we have seen in the last 2 or 3 quarters, it still compares very favorable with the 5-year averages. On a more macro basis, the good news is that oil demand growth for 2018 is still tracking at 1.3 million barrels plus. US, China and India are the 3 markets where most of the demand growth has been seen this year. In India, when we compare year-on-year growth, it has softened a bit to roughly 2.7%, but gasoline is still 6+% and diesel is nearly 3%. So the products that we are interested in are still growing well. And we are expanding our retail distribution, as I said earlier. In petrochemicals business, clearly records both in production, volume as well as margins. EBITDA is up 56% year-on-year. Demand environment surprisingly strong. As I said, we saw nearly 7% growth in polymer demand and nearly 14% growth in polyester demand. In the polyester business, we have seen very strong traction in paraxylene margins. We have seen very healthy PTA margins. Downstream margins have been flat or slightly lower than compared to previous quarter, but the integrated polyester margins are significantly better. Polymer margins have been a touch softer than previous quarter, simply because the new supply coming out of North America has capped polymer prices, whereas input costs have gone up with the higher oil prices. In our upstream business, as you know, oil prices strengthened and are up nearly 45% year-on-year. Our domestic production was down nearly 14% quarter-on-quarter, and our US production is down nearly 11% quarter-on-quarter as we are not drilling and bringing new wells online. CBM production stays steady at roughly 1 million cubic meters per day. We are very focused on getting the new development projects done, which is right now our cluster. We have ordered all the long lead items and are confident about bringing new gas in the market in 2 to 3 years from now. As far as our retail business is concerned, we are undisputably the largest and fastest growing retailer in India. In the last 1 year, we have more than doubled revenues and we have more than tripled EBITDA in this business. This hyper growth is across everything that we do in retail. It's in store count, it's in revenues, it's in our footprint. Turnover in this quarter up to 32,436 crores. EBITDA at 1,392 crores, up 3.1 times year-on-year and 15% quarter-on-quarter. EBITDA margin again healthy at 4.3%, even though it's a little bit softer than the previous quarter due to seasonality, but very much better than what we saw a year ago. And EBIT margin at 3.8%, again very healthy in our environment. Our retail presence is unparalleled. We are now present in 5,800 towns and cities. We have over 9,100 stores open. We have 19.5 million square feet of retail space operational, and we have over 8 million square foot of warehousing space. We saw nearly 137 million footfalls during all our stores in this quarter, up 33% YOY, and our loyalty customer program has now 50 million plus customers. We have been having the big sale day for a few years now. This is the 11th to 15th August period, and this year we set several records. We saw over 10 million footfalls during this period, and we had 4.5 million purchase transactions during this period. Agio.com continues to have very strong customer traction. Over 3 million people downloaded the apps in this quarter, and we now list over 90,000 products, more than twice of what we did a year ago. Moving on to Jio, as I said, the biggest headline is the subscriber base milestone of over 250 million. In less than 25 months, This is the highest rate of customer acquisition for any technology company anywhere in the world. We added more subscribers than all our competitors put together. We added 37 million net adds to subscribers in the last quarter and 114 million net adds over the last 1 year. It is the largest mobile data network in the world. It is the largest VoLTE network in the world. It carried 770 crore GBs of data in the second quarter and 580 crores of minutes of voice traffic every day. Our subscribers are using on average 11 GB per month of data, and we carry roughly 72% of all 4G data traffic in the country. All this is for very good reasons. So when we compare our network with others and we look at all the investments and improvements that we have made in the network, we benchmark our network against 100% availability which we had, the lowest call drop at 0.1%, the lowest monthly churn at 0.66%, and an average download speed of 22.3 megabytes per second, which is roughly twice the next operator. So it is the quality of our network, it is the quality of the experience which allows us to get industry-leading ARPUs of 130 per month. As far as the financials are concerned, as I said, the other big milestone was revenue at exceeding 10,000 crores, in fact 10,903 crores, up 14% quarter on quarter. EBITDA of 3,573 crores, up 14% quarter on quarter, and net profit of 681 crores. All in all, as you can see, that our consumer businesses, both retail and Jio, are gathering momentum, have solid traction, and we expect them to set record quarter after quarter. A short while ago, we also announced partnerships with Den and Hathway to really take cable and broadband to the next level in terms of technology and customer experience, and we look forward to working with both of them in the future. I would summarize by saying that as we look at the 2 quarters that have gone by in this year, we are convinced that all the building blocks for sustainable growth in revenues and earnings are there. Our energy businesses are at the right place in terms of cost competitiveness, leadership in the Indian market, and our consumer businesses are just gathering momentum quarter after quarter, and we should expect to see new records from them in the coming quarters. Thank you very much.